Welcome back to Let's Talk Finances. I am Dr. Nina White. Listen, as I tell you every single week, get your pen and your pad, call your family in the room, call your family and friends, and let them know that Let's Talk Finances is on right now. Okay? If you have been following the series, you know that we've been talking about structure, behavior, systems, protection, investing, and leverage. I truly hope that you have been gaining knowledge from the last few episodes, and I'm telling you, we're going to continue to dive deeper every single day, right? So today, we're talking about something that quietly determines whether all of that works or not, right? Everything that I've said, does it work, right? So guess what we're talking about today? Taxes. That's right, taxes. Yeah, I know many of you don't even want to talk about it, but it's tax season and it's important that you know about it. So now let me make a few things clear, okay? Income alone does not create wealth. A lot of people think that, but it's not, right? What you keep does, okay? You can make $1 million, but if you're giving away $400,000 or $500,000, $600,000 without any strategy, guess what? You're not building wealth. You're working extremely hard to stay financially busy, but not wealthy. You see that? So let's make this simple for you. I'm going to break this thing down to the point a child can understand it, okay? If your child earns $10 and they give away 4, what's left? 6. But if they learn how to legally structure things so that they only give away $2, now they get to keep 8. Get it? So I'm telling you, it's the same income, different strategy, and a different outcome. That's it. For high earners, taxes are not small. They are not background noise either, right? They are one of the largest expenses that you will ever have as a high income earner. So let's make it real. I'm telling you, as I continue, I'm going to break it down so that you understand it on every single level, okay? So if you earn $500,000 per year, right? Depending on your structure, your location, and your planning. These things are key, right? So you could easily lose $180,000 to $250,000 in taxes every single year. So I'm going to say that one more time for you, so I want to make sure you get it. If you earn $500,000 per year, so just put your number in there, whatever that number is. You could easily lose $180,000 to $250,000 in taxes. And remember, this is every single year. So now multiply that by 10 years. That's $2 million. That's right, $2 million. That's a building. That's an investment portfolio. That's generational wealth. Gone, right? Not because you did something wrong, but because you didn't have strategy. That's what we want to make sure that's in place when it comes to taxes. Strategy, strategizing, right? Planning. So now, because you didn't have strategy, hear me clearly, tax planning is not about avoiding taxes. A lot of people think that. They're like, well, if I do tax planning, I can avoid doing taxes. No, we're strategically planning things out, right? It's about optimizing your financial structure. That's just all it is. So it's important that you get with someone, M&D Accounting, of course, about your financial structure, right? Financial planning. It's a complete difference. Avoiding taxes is illegal, okay? You got to pay them. One way or the other, you got to pay them. So it's illegal by avoiding taxes. But optimizing your structure is intelligent. Remember how I've been talking about the way we think about money? This is what we're going to go deeper in it, right? So I'm going to give you an everyday example, okay? Imagine going to the grocery store without a shopping list. Y'all already know where I'm going with it, right? You're going to spend more money not because you're reckless, but because you didn't plan. I do that all the time, okay? Now I write it down because you go in the grocery store without, you in your head you're saying, I'm going to pick up some cabbage or collards, maybe some fruits, a can of this, a can of that, some milk, whatever. Then you end up walking up and down each and every single aisle. And it's, oh, I need this. Oh, I do need that. Oh, I want this, right? So now you spent more money, right? So it's not because you're reckless. It's just because you didn't plan. But now let's talk tax strategy, right? Let's do that. That is what you want to consider your grocery list tax strategy. Without it, you overspend legally. With it, you allocate intentionally, right? You have your list. You know what you got to do. You're going in to get exactly what's on that list and you leave it out. You didn't spend no more money, right? So now, here's another example. You got two doctors, same income, $800,000, right? Dr. A files taxes once a year in April. Dr. B meets quarterly with their advisor. Dr. B adjusts his retirement contributions, shifts his income timing, tracks deductions, and uses proper entity structure. At the end of the year, Dr. B legally keeps $70,000 more. Same intelligence, same income, different planning. See how that works? Dr. A like, hey, listen, take everything to his tax preparer. Here you go. Now he owes more money. But again, Dr. B takes the time to strategize and say, no, I got to meet with this person on a quarterly basis. So by the time it's time to file taxes, I already got things in place. He's saving, right? So that's what we're talking about today, okay? Making sure you understand, what is it? Proper planning prevents poor performance. Now, let's break down what strategic tax planning actually means. Again, I'm going to make it simple. Think of taxes like a game of timing and structure. Income timing. If you know you're going to earn a large bonus in December, right? Sometimes shifting it to January changes your tax exposure. So you want to go and tell them, hey, listen, I know this big bonus coming, but can you move it to next year? Put it in January, right? That is, again, tax exposure. Same money, you're getting the same exact bonus, different year, different impact. Listen, even a child understands timing, okay? If you get your allowance before the school trip, you spend it all, you can spend it there, right? But if you get it after, you can't. Prime example, my son's getting ready to go on a field trip next week. If I give him his money to go buy stuff out of the souvenir store, give it to him before he leaves, he can then spend it while he's there. But if I give it to him after he done came home from the trip, what does it benefit him to do, right? It's all about timing. Oh, I ain't forgot about you business owners. I haven't forgot. Timing matters even more for us as business owners. When do you invoice? When do you recognize revenue? And when do you make major purchases? I'm going to say that one more time. Business owners, listen. Because if you write this down right now and you take the time to be able to strategically answer these questions, it's going to help you in the long run. So again, when do you invoice? When do you recognize revenue? And when do you make major purchases? I just want y'all to pause right there. Right there. These decisions affect what you owe. You gotta, I'm telling you, this means so much, okay? So make sure you take that and meditate on it, right? And really deep dive and look at everything, look at all of your numbers. Just go back and see how it has affected you and answer these questions yourself. Next, we're going to talk about deductions, right? Deductions are simply a legitimate business or investment expense, right? That's all it is. So we just going to simplify it for you. If you earn $100, right, and you spend $20 running your business, you should not be taxed on the full $100. You should only be taxed on the $80. That's fair, right? Y'all get it? So I'm using small numbers so that y'all can kind of figure it out, right? But here's where high earners lose their money, right? They don't track properly. They don't plan purchases intentionally. And they don't structure expenses strategically. Again, it's all about planning. It's all about planning, right? They react to it. So that's what happens with high earners. They react to everything. So when you got something in place, you're planning, it makes it a whole lot different, right? Strategic individuals forecast. I literally just did this for a client. Literally lined up what they came to us in maybe 2024. And once we got their records from their previous accountant, we're able to strategically help them forecast. So what I did was I took their 2023 and I did it all the way across to forecast for 2026. So they had a budget in place for every single year. 23, I looked at what they budgeted for, their actual expenses. Same thing, we're going to compare it to 24, their actual versus what they budgeted for. And then we did 25, same thing. Then we were able to forecast for 26, but you were able to see the highs and the lows and the consistency or whatever based on their revenue coming in and their expenses going out, right? So when they looked at it, now you can see where you got to make cuts at. Do I need a cut here? Do you need to change another vendor? Things like that. Talk to the vendors and renegotiate prices. All of that comes into play, right? So you want to be strategic in forecasting. So again, forecast, right? And when you know your numbers, you're able to do that. You're able to look back and see the difference, right? So then we're going to go into retirement contributions. So retirement accounts are not just a someday. Someday, one day I'm going to quit. Someday I'm going to sit and be home and I'm going to travel the world. That's not what retirement accounts are about. They are a powerful tax tool. Listen, I have several elderly clients, they're now retired, and they have all types of tax accounts. Once we discuss certain things, we were able to lower their tax liability and the benefits. So these are powerful tax tools, okay? If you contribute to certain retirement plans, you lower your taxable income today, right? So that means you keep more capital working for you now. So let me explain this. I'm going to explain it to you like you're 5 or 10 or maybe 15. But we're going to break it down so that you get it. So if you earn $100, right, and you put $20 into a special savings account, the government approves, right? Because there are accounts that are government approved. So you might only be taxed on $80. But guess what you still own? You still own the 20, right? Because you put it away in a special account. It's just growing for later. So when you put it away, it's growing. So by the time you need it or you want to pull from it, it has done its work for you. That's the smart thing to do, right? Get it? Okay. So for high income earners, This becomes even more important because the higher your income, the higher your expense, the higher your lifestyle, right? Because now you're in another tax bracket, more money's coming in. Now you're spending a little bit more because you're able to do that. You might want to travel, and now you can ride first class, whereas before you was coach because you're making more money now, right? So again, it's because the higher your income, higher your exposure is, right? So you get exposed to more when you got more money. If you don't really have any money, you really can't go nowhere. You might leave from North Carolina and go to South Carolina and go to the Myrtle Beach. But you got a lot of money, you might leave from North Carolina and go to Dubai. See what I'm saying? Same tactic, just different income levels. So then we're going to talk about the business structure. This is where I have clients that are really confused about certain things when it comes to structuring your business. So many people literally just start businesses, and they have an idea in their head and they just go for it without anybody sitting down and really strategically planning things with them. Where does it begin? And then you work on your ending points. So for instance, you have an idea in your head. I want to start I want to start my own restaurant. Okay. So you want a restaurant. What does that look like? What kind of restaurant? Who do you cater to? Is this restaurant already existing somewhere? Is somebody already doing the work, doing the same thing? What are the prices, right? It's in your head, but now you got to get it on paper. So the first thing you want to do is you want to run out and get websites and business cards and all of this. Hold up. Let's start, in the earlier stages. It's in your head, but you're ready to go do all this other stuff. No, now you need to sit down with a creative person that can be able to create this for you. Then we're going to work on the image and the logos, and then we'll, go all the way. It's a process. Business owners, LLCs, S Corp. So S Corp is S Corporation, C Corp, C Corporation, and then you have sole proprietor, right? Each structure has different implications. Think of it like containers, right? Let's use my water bottle, for example, right? If you pour water into different containers, the shape changes. So if I had a square bottle and poured my water in it, then it shapes the square. This is right here, this is the way it's shaped, right? So circular, water looks, this is the way it shapes. So think of it like containers. So the water is still water, but now it's held differently, right? It's shaped differently. So I haven't drunk the whole bottle yet. So income is the water. Income is the water. Your entity is the container that it's in. The wrong container can cost you tens of thousands annually, right? But the right one can protect and preserve. So literally just think about it like that. So of course, you want to think about it. It's just a container. You're just using a different container. So now if you go, when you pour this amount of water in a 10-gallon container, what have I now done? Now I'm costing more, right? So you got to look at it like that. Or if it's overflowing, right? You got it in the wrong container. So that way you're spending more money annually. So what you want to do, again, you want to forecast. Tax planning is not April, okay? This is why I want to say maybe it was last episode or the one before that, and I was telling you all that it is important to get with someone and do tax planning throughout the year. So by the time April comes, you're not chaotic and all of that. And what happens is you get into a crunch. And so tax planning is not April. It's January through December, okay? So high-level wealth builders forecast, right? They ask this question: What will this decision cost me in taxes before I make the decision, right? So again, you got to strategize. You need someone to help you plan. If you don't have it down to a science, it's okay, right? The question alone separates reactive earners from strategic wealth builders. Again, that question alone separates reactive earners from strategic wealth builders. So just understand, if you want to strategically build your wealth, get with someone, M&D Accounting, to do your tax planning. Someone that can guide you along the way. And remember, you don't have to do this every month. You can actually sit down with someone on a quarterly basis. But importance is knowing your numbers. It is so important to know your numbers. Here we go. They're thinking, how do we think about money? We want to continue to think like a CFO. Yep, I'm saying it again. I'm going to drill it till you get it. A chief financial officer. Even if you're an employee, right? Even if you're a solo entrepreneur, think CFO. CFO thinking changed the way that you think about every single thing, right? It doesn't put you in a situation where, again, you're thinking positive about money. You're not thinking negative. CFO thinkers are strategically planning, right? That's what they're doing. And so I want you to get it about being a CFO thinker. Don't feel like, oh, I don't own a business, so what does that mean to me? It doesn't matter. We want to change the way we think about money. A CFO does not say how much money did we owe. They ask, how do we reduce risk and preserve capital, right? Taxes are part of risk management. You're going to pay them. You're going to have to pay them no matter what. Just about how much is based on how strategically you plan these things out, right? So, if you overpay taxes every year by $50,000, that's not just money loss, right? That's investment growth. Remember I just talked about earlier, where you lose so much money. And it could have been a building that you could have purchased. It could have been, a portfolio. You stop throwing away money. If you got a trash can and you literally saw how much money that you put in the trash, then you will make sure, you'll say, I need to stop and I need to be strategic about this, right? So if that $50,000 were invested at an 8% annual for 15 years, that's over $150,000 in growth. Now that's opportunity cost, right? Even a child can understand opportunity cost. If you spend all of your allowance on candy, you can't buy the bicycle later, right? Adults do the same thing. We just call it tax exposure. That's all. So strong tax strategy preserves capital, supports long-term planning, protects investment growth, and strengthens overall financial health. When you stop viewing taxes as a once-a-year inconvenience and start viewing it as a controllable financial factor, you move from reactive to strategic. And that shift is powerful, okay? Listen, I'm telling you, high income without strategy creates pressure. And high income with strategy creates freedom. So listen, here is what I want you to take away today. Taxes are not just an obligation, they are wealth variable. And variables can be managed. Income matters, investing matters, leverage matters, but what you keep determines what compounds. If you're ready to move beyond basic tax filing and into proactive tax strategy and wealth protection, reach out to us at M&D Accounting Firm, because filing is compliance, strategy is wealth preservation, okay? If you have any questions or any question that you want me to answer on the next episode, text us at 1-844-436-2788 or email us at contactus@mdaccounting.org. I believe my QR code is floating around here somewhere. You can scan that as well. And listen, if you have any questions or you want to schedule an appointment, call the office at 1-877-839-7778. I'm Dr. Nina White. Thank you for joining me on Let's Talk Finances. And remember, it's not about how much you make. It's about how much you keep and how intelligently you can grow it. I'll see you next week.